Okay, and let's go ahead and start to look at chapter 2. Okay, and for chapter 2 now, we are going to start to talk about something called job order costing. Okay, now we started to understand a little bit about the accounting system and how we use the accounting system to gather costs associated with our jobs. And remember, we had our product costs, we had our manufacturing costs. We had some different names for those. We called them what? Product costs. We called them manufacturing costs. And we talked about what? We talked about our direct labor, our direct materials, and our manufacturing overhead being our product cost. And the manufacturing overhead was something that was indirect. So our indirect labor, our indirect materials, and our other overhead costs went into the overhead pool and had to be applied to our product cost in order to being captured as product cost. We then took those product costs and we did what? We put them to work in progress, and then we went from work in progress and we took our cost of goods manufactured, sent that to our finished goods, and then once we obviously sold those items, we took them out of finished goods and put them into cost of goods sold, right? So we followed that flow, and what we didn't talk about was the type of system we are using for that flow, and that system is called, that we're going to talk about in this chapter, is called job order costing. Job order costing, and you can see on this slide, job order costing is something that is used for unique products that we are manufacturing. For example, every film that Disney makes is unique, and so they would track their costs by film. We call that job order costing. If we were talking about producing airplanes, every airplane is going to be different, so we would use job order costing, and we would gather our costs specific to each job. Plane number 1, plane number 2, etc., right? Movie 1, movie 2, etc. Now, in chapter 3, we're going to talk about something called process costing. Process costing is a system that we use if we are producing homogeneous goods. For example, if we're producing cornflakes, it's not going to be possible to track our cost by box of cornflake, right? So we're literally going to track our costs as we go from department to department. As we go from the flake department to the box department, we're going to track our costs by department. But that's the next chapter. This chapter we're using what? Job order costing. We're going to track our cost by job. Okay, so a couple of questions that you'll see, potential questions that you would see on your exam that I've included in here. And we say large aircraft producers such as Boeing would use what? Would use job order costing, not process costing. If it was cornflakes, if it was soda, right? You don't track your cost by a can of soda, right? And so we would have to use something called process costing for that, and we'll get into that in the next chapter. More of an application type question here. Job order production system would be appropriate for a company that produces which of the following items? Landscaping design for a new hospital. Look, the landscaping at a hospital is going to be different than the landscaping at somebody's personal residence versus the landscaping here at the college. Each project is different, right? Okay. Now, the other way you could answer this question would be to back into seeds, for a growing lawn or something. Obviously, that's not going to keep track of the cost by bag of seeds, sacks of yard fertilizer, packets of flower seeds, small gardening tools. These type of items we'd use what? Process costing as we go from department to department. I don't know how they produce fertilizer, but let's not get into all that. From the fertilizer department to what? To the bagging department where they stick the fertilizer in the bags, whatever. Okay? All right, so just a sense of that, you'll see some questions like that on your midterm. We'll practice more with those type of, definition questions. I find that sometimes for the students, the definition questions are the harder ones. The numerical ones you get used to the process and you study hard on that, and then it's sort of the definition ones tend to blindside us a little bit. So I'll try to get some more of those so that you get comfortable with some of these definitions. Okay, so if we're using job order costing, we're going to track our cost by job. So what are our product cost, our manufacturing cost include our direct labor, our direct material, right? And we see those going to these jobs. Now, they all our manufacturing overhead going to these jobs as well. However, we're going to have to apply the manufacturing overhead to these jobs. So our actual overhead will go into our manufacturing overhead account, but then we will apply the cost to these jobs using something called a predetermined manufacturing overhead rate. So if our predetermined manufacturing overhead rate is, say, $2.50 per direct labor hour, for every direct labor hour we spend on a job, we multiply the amount of direct labor hours by that $2.50 and we apply it to the job, right? Because we can't trace those directly. So even though the arrow is pointing straight to it, it actually would go into a what? A pool and then be applied to the job as we incur whatever the driver is. Often in, when we're studying this, it's through direct labor hours. Okay? All right, so you're going to see we're going to spend quite a bit of time with that predetermined overhead rate here in a little while, and I think this will get much more clear to you about how we deal with the overhead as we go along. This is called a job cost sheet, job cost ticket, whatever. I think it's anticipated here that this would be filled out manually the way they're showing this. Obviously, these days, what would happen? Probably somebody each day goes in and fills out an electronic time card of some sort that talks about the amount of hours they spent on that job, the materials that were used on that job, etc., right? And so we go ahead and we have this job, I don't know, it's job number A143, and we're making this item up, this wooden cargo crate, etc. Okay, and then we go ahead and we start to gather our cost here, and so we get our direct materials. Okay, our direct materials, whatever the direct materials were, direct materials total on this job was $116, right? Okay, then what? Then we'll accumulate our direct, we roll that up, the direct materials, right? And then we'll go ahead, our direct labor cost here, we're paying this person $11 an hour. Okay, we're not paying them very much, but that's neither here nor there. This is not Business 125B where we might talk about the ethical dilemma of only paying somebody $11 an hour, right? But anyway, we're paying them that money, and so we go ahead and we gather their cost, $88. We add that to the job cost ticket. So we've got our labor, we've got our materials now, right? Okay, what are our three product costs, our three manufacturing costs? Labor, materials, and overhead, right? And so let's go ahead and grab that manufacturing overhead now. Now, what we're going to do is we've said we're going to apply. They're talking about an allocation base. They really should be talking about, allocation base. They probably should have said an application base, but we're going to base our application of our overhead based on some driver, whatever the driver is that's most appropriate that we think drives our overhead cost. So if sitting in our overhead, most of our actual overhead is indirect labor, let's say, then it makes sense to use what? Direct labor hours as our driver for our overhead. Okay, now in this class, we're not going to be sitting there saying, okay, you gotta figure out what the driver is. We'll always give you the driver, but in a practical case, you'd have to know what is driving your overhead most, and that is what you would use to choose your application base. For example, if most of the cost associated in our overhead account was, say, electricity, our utility, because we are using a lot of machinery to produce our product, then we would go ahead and we would use what? Maybe machine hours to allocate our overhead. I was on an assignment one time where there was this plant in Henderson, Nevada, that produces the oxidizer that helps rocket fuel burn. Okay, it produces the oxidizer that factory did that helps the rocket fuel burn. Rocket fuel is needed for what? For missiles and that sort of thing. Okay, well, they got a little sloppy in one. There's 2 plants in the entire country, both outside of Las Vegas. 2 plants that produce this oxidizer. 2 plants in the entire country, both in Henderson, Nevada, outside of Las Vegas. So one of them got a little sloppy, and the whole place blew up. They were spilling the stuff around. They weren't using the proper maintenance and cleanup, taking the proper safety procedures. One spark blew the whole thing up. And sometime Google Henderson, Nevada factory explosion, and the thing exploded for like 15 minutes. It was this horrific thing. So what happens? Congress gets a little concerned because they say, okay, you mean to tell me we only have 2 of those plants and one of them just blew up? Well, now all someone has to do is what? Blow up the second one, and we can't produce the oxidizer for the rocket fuel for our missile systems and that sort of thing. They say, GAO, go look at that. So somehow I get on that assignment, and of course I'm trying to turn it into an accounting thing. Let's see, beginning inventory plus amounts produced gives us goods available for sale minus the ending inventory would be the amount that got blown up. Okay, so they're like, okay, John, that's cute, but we need to look at some security issues a little bit around these different plants. And so we started to learn about this process, and in that process, what we learned is the reason they have those plants outside of Las Vegas is because you have the Hoover Dam right there, and the electricity is fairly cheap, and they use large amounts of electricity to produce this oxidizer for the rocket fuel, and that's the reason they have the plants there. And they say that's the reason Las Vegas is lit up 24/7, because the electricity is so cheap, right? So what's happening? If you were that plant, although I think that would be a process costing system instead of a job order costing, but if you were that plant, what? Your driver for your overhead would probably be your electricity, so you would probably use machine hours, whatever, when you apply. Okay, so it's whatever is driving your overhead the most, okay, that you select. But again, we'll give those to you in class. Okay. Okay, so you come over, and what the company would do is they would come up with their total estimated manufacturing overhead cost for the coming period. Okay, so they're going to be estimating that. They're going to be doing this for 2016, probably in June of 2015 or something, right? So they're doing this, ahead of the actual start of the year, whatever. And so let me see if I can put this in tablet mode without creating a disaster. Shouldn't make any difference. Okay, that's the one thing I like about this laptop, is when you put it in tablet mode, as far as the projector is concerned, nothing has changed. And other ones, the Surface, you have to sit there and unhook it and snap it and turn it, and it's a whole thing. So I'm going to continue to use this clunky computer because it has some things that I like better. Okay, but what is it? The key thing here is what? Estimated, and we do this, and we're doing it for what? For the coming period. So we're doing this before we have even started to produce one item in the new year, right? Okay, we're maybe doing this in June of 2015 to help us with 2016. Then we will go ahead and estimate the total units that we're going to produce in the coming periods. So we estimate what our predetermined manufacturing overhead rate is, and then we'll use that throughout the year. Now, the burning question is, well, what if your estimate is incorrect? We're going to make an adjustment for that at the end of the year for our financial reporting financial reporting process. Don't worry, we'll deal with that. Okay, but that becomes my allocation base, and I use that throughout the year as I apply, say, direct labor to a job. I'll take whatever that predetermined manufacturing overhead rate is times the direct labor hours, and that's how I will come up with the amount of overhead I'm going to apply, my predetermined manufacturing overhead rate. Now, how will we come up with this estimated amount of predetermined manufacturing overhead? Essentially the numerator in that fraction that we just saw on the screen a minute ago. Okay, so what we're going to do is we're going to sit here and think about the equation for a line. Okay, when you have an equation for a line, you are used to this from your study of algebra. Okay, everyone's had algebra at some point, right? Okay, so let's just go ahead and let's take a look at this. And you remember y equals mx plus b. Does everybody remember that? Y equals mx plus b. Okay? Okay, this is a good time to pay attention up here, guys. Y equals mx plus b. You remember that. And we remember that what? Y is going to be the total, and in this example, we're calling that the total overhead cost that we're calculating. That's our total cost. Okay? And then what? The m is going to be the slope of this line. The m is going to be the slope of this line. And then the b here is what? The b is the y-intercept. Okay? The b is going to be the y-intercept. So we could go ahead and rewrite that y equals mx plus b, and we could rewrite it, okay, to match what we're doing here. We're taking what? Total overhead cost, and they've changed this up a little bit here. The way I wrote it was y equals, and we had this as b plus mx. Okay, so we just wrote it a little bit different. We wrote y equals, I wrote mx plus b, but b is my fixed cost. And so if I'm sitting here and I'm looking at my total cost, just to put it back to the graph, if this is my what? Total cost up here, and this is my x-axis, this is the number of units I produce. And remember, guys, what did we say about fixed cost? What are my fixed costs remain regardless of the number of units I produced, right? Okay, so if they're telling me that my fixed costs are 40 here, then even if I produce 0 units, no matter how many units I have, I still have that fixed cost, don't I? Right? Okay, then what? Then remember we said my variable cost, okay, my variable costs go up as I produce units, don't they? Okay, so the more units I produce, the more variable cost I'm going to get. So what happens? If this line right here represents my total cost right here, my what? My total cost line is automatically pushed up by the amount of fixed cost, because that fixed cost is always going to be there. And then as I start to produce units, my total costs go up at the rate of my variable cost per unit, right? That rate is called the slope of this line, isn't it? Okay, so it fits with the idea of y equals mx plus b that you see in your algebra classes, right? Okay, now what happens? Can we calculate the slope of this line? Can we calculate the slope of this line? Well, you remember that to get the slope, and I'm going to go back to a y equals mx plus b now. You remember that what? The slope of the line is y2 minus y1 divided by what? x2 minus x1. Good. I'm sorry, what's your name again? My summer student who was taking calculus? Jarna? Yeah. Aren't you glad we're not having to do the limit as x moves towards 0? Okay, right? Okay, so it's not quite to calculus, much more basic in just our approach on algebra, right? Okay, so it's y2 minus y1 over x2 minus x1 is going to equal the slope of this line, right? Okay, now what's going to happen? What we're going to do is we're going to say, well, okay, great. If we want our variable cost, then we're just going to take our total cost 2 minus our total cost what? 1. And we're going to divide that by, and whatever our driver is, say direct labor hours, our number of units, whatever, x2 minus x1. Won't that give us our variable cost? So we should be able to calculate our variable cost using this approach, and that will allow us to get the equation for this line. And then once we get the equation for this line, we just simply plug in the number of units. And remember, we said at the beginning of the year, or before the year even starts, we're going to just estimate the number of units that we're going to produce. That'll allow us to predict what our total overhead costs are going to be, and then we can use that to apply our overhead throughout the period. Okay. Now, there are make that line for us. So since the costs will not line up perfectly along that line, okay, we're going to use regression analysis and ask the software to sit there and pretty much estimate a line that fits around where those observations are. They call that regression analysis. And when we do the regression analysis, it spits out a formula for us, and they don't use the parameters the way we talk about in regression analysis. They still use y, but the fixed cost is a and the variable cost is b, and they still use x, so that's why they were using different variables for this line, okay, than what we use. We use total cost and variable cost, etc. Now, I am not going to obviously ask you to do regression analysis. You'll have plenty of time to work with that as you move on. You get your bachelor's for your associate's degree to transfer, and you transfer. And trust me, every other class they'll want you to do another regression analysis. So we don't have to worry about that in here. We are going to use a much more I'm going to have you understand. We're not going to test you on it. Now everybody's going to stop paying attention. I'm not going to test you on it, but I'm going to have you understand a much more basic method for coming up with the equation for this line, and it's called the high-low method. And with the high-low method now, what we do is we go ahead and we take a look at our activity for these different months. And the only reason this example only did 6 months is because they don't want to take up the whole page here with a bunch of different data. And so they went ahead and they picked up 2 months. They pick up the high month and the low month. Okay, so the high month here is what? What's the high month looking at the amount of maintenance? 850, good. June is the high month. The low month is what? February for 450, and then we go ahead and we find the total cost associated with each one of those, don't we? Okay, and so now we can go ahead and we can get the slope for this line, and so we just go ahead. Okay, and let me get my pen on the right color here. We just go ahead and we take this, what, 9,800 minus what, 7,400, good. That's sort of like my y2 minus y1, whatever, and we're going to divide it by our level of activity at the high is 850. my level of activity at the low is what, 450? With me so far? And so when I do that, I get a difference of calculators, guys. Coming to this class and not bringing the calculators, like going to a guitar class and not bringing your guitar. Okay? Calculators, please. Okay? 9,800 minus 7,400 is going to be what? 2,400? Okay. There's a 2,400. Okay. And then 850 minus 450 is what? 400. Good. Okay. And so that's where and I'm sort of rewriting the calculation down here just because I want you to do it. Okay. That's $6 per hour. That's my variable cost. Don't I have my variable cost now? Do I have my variable cost now? Okay. So now that I have my variable cost, I can go ahead and figure out my fixed cost, right? Okay. And so you come over and you take a look, and they tell us that to figure out our fixed cost, we will simply do what? We will simply follow this formula. Total fixed cost equals total cost minus our variable cost. And you can do this at either the high point or the low point of this graph. Now, when we picked high and low, all we did was we picked what? We picked the lowest point for any one of the months. I guess that was February, right? And then up here was whatever month that was. It was the high month, And they just sort of forced the line to do what? To adhere to those 2 points, don't they? They're just saying that the line must adhere to those 2 points, even if it really doesn't. Even if it really doesn't, they're just saying, okay, that's all right. We're just trying to come up with an estimate here, aren't we? So they're forcing the line to fit there. And when you're trying to figure out now your fixed cost, you can use the high point or the low point. So are you a high person or a low person? High? Okay, so let's go ahead and use the high then. So what do? I go ahead, and that's exactly what they did here. The total cost at the high of 850 hours was 9,800. And then what? We subtract off what the variable cost would be at those 850 units, and that difference gives me what? Gives me my fixed cost, doesn't it? Gives me my fixed cost? Yes. Total cost minus variable cost got to be fixed cost, doesn't it? Okay, and so then I just sit here and I say, okay, now I have a total cost line for my overhead regardless of the level of activity that I have. I know that it's going to be what? $6 is my variable cost per unit times what? Times the number of units, hours, whatever it is, plus what? Plus 4,700? Right? That's my fixed cost. So if this company thinks that they're going to produce, I don't know, in the next year, what would be reasonable here, 1,000 units a month, then they would plug in 1,000, and that's how they would come up with their predetermined manufacturing overhead rate, right? Okay. So let's just go ahead and do I want to do it here? Let's go ahead and let's look at an example problem, although it's not going to be on your exam. Let's go ahead and practice with this again, and we're going to actually take a look. Okay, well, there's the formula. Let's do it here. There's the formula. Let's just go ahead. Let's do it here. Why not? Okay. So what happens? So what did I say? 1,000 units is what I'm going to assume that you're going to produce? Okay, so they've done this analysis, and they say, okay, next year we think it's going to be 1,000 units. So what happens? They go ahead. Do they know for sure that it's going to be 1,000 units? They're estimating that, so they're going to say that their total cost is going to be equal to 6 times how many units? 1,000 units. Okay, plus what? Plus 4,700. What's that come to? 10,700. Even I should have been able to do that one in my head, right? Okay, good. 10,700, and then I will divide that by how many units? By 1,000 units. That says 1,000 units by 1,000 units. And that should give me my predetermined manufacturing overhead rate that I will then use throughout the new year, say in I'm doing this in 2015 for 2016. So throughout 2016, I would use what rate? 10,700. 10,700 divided by 1,000 is 10.7. Okay, so I'm going to use $10.70 per machine hour, per direct labor hour, whatever my driver is, and I'll do that throughout the year as I carry on and manufacture my product, right? Because I have to apply those overhead items. Okay? Okay, good. So you take a look, and I know this one's a little hard to see on the screen. I don't think I can make it. I saw it there for a minute, but let's just go back to okay, and let me go ahead and turn this into the highlighter. And so I don't know how well you can see it. Can you figure out the high month here? 520 looks like it. Okay, 520, and we've got the level of activity at 520. The cost at 520. Can you find the low here? Good. The low is 300. Very good. Okay, and so where are we at? 2282. Okay, is our cost. So we're just going to go ahead and use the high-low method. And so when we use the high-low method, we're going to take this 4470 minus what? 2820, and we're going to divide that by 520 minus 300, right? And what's the math on that come out to? 4470 minus 2820 is, just do that top part. Give me the math on the numerator. Huh? Guys, I can't do it if you give me 50 different numbers. What is the number? What is 4470 minus 2820? 1670? Okay. What is it, sir, in the Giants hat? 1650? Okay, so it's 1650. Use your calculator for this, guys. And we divide that by what? 220 or 280? 220? Okay. 220? Okay, so that's 220. All right, good. And now we get what? And I think you already are already there, but I just want to make sure that, anyone watching this can see exactly how we did this. We get the 750, don't we? Okay, so we've got the 750, and now notice they go ahead and they figure out their fixed cost, and so we can pick the high or the low. You want to use high or low to get my variable cost? Got to get my variable cost now. You a high person or you a low person? You want to use high? Okay. So we're going to go ahead and we're going to say what? Our total cost minus our total cost minus our what? Variable cost will equal our fixed cost for us, won't they? Okay, so our total cost at the high, we already know is this what? 4470? Right? And then to get the variable cost, we're going to have to take the 750 times what? Times 520. Good. And that then comes out to be what? Comes out to be 570 is our fixed cost. Okay, good. 570 is our fixed cost. So now we have our cost line, don't we? We know what our overhead cost is at any level production. So our total cost will be equal to 750 times X plus what? plus our fixed cost of 570, right? And then in this problem, they were asking us, well, if you're using 420 as your estimated amount of hours that you're going to use, then we predict that your total cost using the high-low method should be 3,720, right? Which was the answer to this question? Okay. Can you come up with a predetermined manufacturing overhead rate? Can you come up with a predetermined manufacturing overhead rate? Okay, so you want me to take this 3720 you're saying? What? No. To get the predetermined manufacturing overhead rate, I take the 3720, my total cost, and I divide it by what? 420 units. That gives me the predetermined manufacturing overhead rate, doesn't it? Maybe what you wanted to do is take the fixed costs and come up with a fixed cost per unit and then add that to the variable cost per unit. Yeah, I suppose you could do that too, okay, if you want to. I'm going to push you to do it this way because, guys, on our exam, most of our problems are going to start giving you the equation. All I'm showing you is how we get the equation, just so you have a little contextual sophistication on where these equations are going from. When we get to our exam, we're going to start you with that line, right? And so with that equation for the line, you'll plug in the number of units. You'll get the total cost. You divide that by the number of units. That's our predetermined manufacturing overhead rate, isn't it? So what is it in this case? Huh? 8.86, you say? That's my predetermined manufacturing overhead rate? Okay. Question? Okay, let's go ahead and let's now just look at how we are going to come up with the rate. And notice, guys, they've just gone ahead and they've gone back to their A being their fixed cost, B being their variable cost, whatever. I like to just put in what I'm looking for here. Total overhead cost equals variable cost per unit plus the FC, the fixed cost, whatever. Again, they're using those Y's and those A's. And I forgot to show you on that previous slide, that output was actually what comes out of Excel if you use regression analysis, and it tells you all kinds of different parameters there that then give you the equation for the line, and there's certain things that tell you how strongly correlated the two items are that you're looking at. There's also something called a t-statistic, and if that t-statistic goes beyond a certain tolerance point, that is telling you step away from the regression analysis. These items are not related the way you think they are, and you should not use this for your analysis, okay? So it's much more sophisticated tool that you'll learn about as you go along, right? We're using a very rude tool, which is saying, the 2 points, and we are hoping that, you know, the line kind of adheres to these 2 points, right? In reality, it may be all over the place, right? But we try to give ourselves, regression analysis uses statistical methods to see how close those points are to that line and tell you whether or not you can use that method, okay? Anyway, so that's why they're using this A plus BX, because they're trying to link it up to the way the regression analysis spits out the factors. Anyway, we're sitting here and we're saying that our fixed costs are what? 200,000. Our variable costs are $2.75 per unit. We go ahead and plug in the number of units that we think we're going to produce for the period. That gives us our total estimated overhead cost for the period of 640,000. We divide that by the number of units. Do we have our predetermined manufacturing overhead rate? Do we have our predetermined manufacturing overhead rate? Okay, and now as we work on our jobs, we go ahead and we apply our overhead cost to our jobs based on this predetermined manufacturing overhead rate, right? So Steve, how do you come up with the predetermined manufacturing overhead rate? How do you come up with the predetermined manufacturing overhead rate? Huh?
Overhead cost divided by
Total cost divided by units.
Total estimated cost, right? Divided by what? Estimated units, and I'm emphasizing that estimated because what? We really don't know yet, right? And we're just going to apply it based on that beginning of the year estimate, or prior, really probably we're sitting here in June of 16, and we're going to use that in what? 2017. So this is sort of a planning tool, isn't it? Okay. Huh? Yeah, we're not thinking it so much from budgeting right now, but we could use it for budgeting, and we'll get into budgeting later. Right now, tell me your name again. I'm sorry, Marcel. Right now, we're just using it as a way to capture our overhead cost job to job, right? Because really, guys, in these first few chapters, when we're talking about job order costing, process costing, we're really still sort of in the external accountant's mode, trying to gather the cost information so then we can report on our balance sheet, our inventory, we can report on our income statement, our cost of goods sold. Okay, it's not until we start getting into cost volume profit analysis that we finally get to the major objective of this class, which is to teach you how to analyze a set of financial statements to make internal business decisions. Okay, so anyway, so that's really the reason we're doing this now. But yes, we can also use this information for budgeting purposes as well. Okay, and we'll see that in later chapters. Okay, good. But it is estimated doing this at the beginning of the year so that we can capture our overhead cost, and if we did this based on direct labor hours, and they're telling that our predetermined manufacturing overhead rate is what? $4, that we just went through all that trouble to calculate, that means that we are going to capture what? $32 of manufacturing overhead for this job. So we have now gathered our product cost, haven't we? We've gathered our direct labor, our direct material. That was pretty easy, just however many hours we spent on that, how much material we used on that. Then what? Then we had to go ahead and use our predetermined manufacturing overhead rate to apply the overhead to this job, right? Okay. Okay, so we captured our cost on this job. So let's go ahead and let's take a look at a couple of example problems from your quiz here. And we have what? We have this company that bases predetermined overhead rate on estimated machine hours for the upcoming year. At the beginning of the most recently completed year, the corporation estimated that machine hours for the upcoming year would be 10,000. So they used the what? Experience that they had from the previous year to figure out what their machine hours were going to be for the next year, right? Okay, and then they went ahead and they said that variable manufacturing overhead was estimated to be $682 per machine hour, and total fixed manufacturing overhead is $230. Okay, and we want to get the predetermined manufacturing overhead rate. So who wants to set that up for me? Who wants to set that up? Total cost is going to be equal to what? Okay, I like to put my variable cost first. 682. Good. Times what? Times 10,000 units. Good. Plus, who's saying that? 230,200? Like that? Right? Okay, so can you tell me then? Just do the math here, and you know that we have to do the multiplication first. 298,400, you say, sir? Okay. And now what do you want to do? Divide it by the units, right? 10,000 units? Nice. And what do you come up with? If you don't come up with this, I have some fancy footwork to do to explain why that's the case. Do you get that? Okay, so I didn't lie. I told you we would start with what? Giving you, we didn't actually give you the equation, but we gave you the pieces of the equation. You had to assemble them to come up with the total cost, divide that by what? By the number of units, and you were able to get the predetermined manufacturing overhead rate, weren't you? Hello? Okay. Okay, good. Let's go ahead then and let's take a look at this one. This is, again, one of those annoying definitional questions. A job cost sheet shows information about each of the following items except, does it show direct labor? Yes, it does. Does it show the name of the customer? Okay, I guess, whatever. Some of these questions are beyond annoying, right? C, the cost incurred by the marketing department? No, remember the job cost sheet is gathering our product cost, our manufacturing cost, our direct materials, our direct labor, our manufacturing overhead, our what? Our administrative cost, our selling and administrative costs get expensed each period, don't they? Remember what's going to go on, guys. We're going to gather our manufacturing costs. We're going to put it to work in progress. Once that item is done, it's going to be transferred from work in progress to finished goods and sit on the balance sheet until we sell that item. And when we sell it, it's just like accounting thank you, just like A, Business 101A, where we will simply do what? Debit the cost of goods sold and credit the inventory, right? Okay. Okay, good. Oh, boy, is this the same question? Some things are so great you got to do them twice. Okay, I'm not sure. I guess I thought I had a different question in there, so we won't do it twice. I think you get the point, right? Okay. All right. Good. Here's another one. Now this one's a little bit different. And I put the solution down here because we had to figure out which of these costs were overhead costs first to come up with what? To come up with our total overhead costs. And then once we did that, we were able to come up with the predetermined manufacturing overhead rate. So let's just take a look at this, and we say that we have this information. They estimate 20,000 labor hours will be worked, and if overhead is applied based on these hours, what is the manufacturing overhead rate? So this one was a little tougher because you had to look up at this list of costs and figure out which ones would even go into the numerator, and once you got that, then you could go from there, right? So how about rent on the factory building? Well, I'm reading from the solution. Why don't I read from the question? It's much more meaningful, don't you think? Okay. So how about direct materials? Is that overhead? Direct material overhead? No, it's not, so I'm not going to pick that up. How about direct labor? Nope, that's not overhead. I'm not going to pick that up. How about rent on the factory building? Yes, it is. That comes down. I'm going to try to calculate my overhead, right? How about salespeople salary? No, that's not overhead. That gets expensed each period, right? Remember, we're gathering our product cost here, right? So we can report those on the balance sheet until we sell those items, and then they'll go to cost of goods sold in the income statement. Remember, we said selling administrative expenses go straight to the income statement because it's too hard to what? It's a poor matching if you gather those in inventory and try to wait till you sell those exact items. Just simply do what? If I had advertising, that must have driven my sales for the period. Better matching just to expense those as incurred, right? Okay. Okay, good. How about our depreciation on the factory building? Is that overhead? Yes, it is, although it begs, why do we have both depreciation and rent? Okay. Oh, I see. Yeah, that makes sense. Why do we have rent? Oh, it's on the rent on the factory building. Oh, depreciation on the equipment. I see. So we're renting the building, we're owning the equipment and depreciating. Got it. Okay. Okay, good. Then what? How about indirect labor? That goes into the overhead. Good. How about production supervisor salary? Well, he's also or she's also a what? An indirect labor, aren't they? Okay. So we add all of that up. There's our numerator, and then we divide it by the estimated number of hours. There's our predetermined overhead rate, right? So the only thing that made this question different from the other ones we were looking at is instead of just giving you the overhead cost, you had to go through a list of items and figure out which ones were overhead, which ones were product cost. And we had an exercise like that in Chapter 1. Remember the one where we had X's and you had to figure out whether they were product cost or period cost? So very similar approach there. Okay? Okay, good. So we go ahead, go back, and this is really a review here. Okay, we already talked about this stuff in Chapter 1, but before I start whizzing journal entries or, talking about the journal entry specific to the overhead, I think it's worthwhile that we go ahead and review what we talked about from Chapter 1 about how we take our cost from raw materials, take it to work in progress, take it to finished goods, and how we will then, what we take to finished goods is our cost of goods manufactured, and then of course we take our items out of finished goods and to cost of goods sold as we sell them, right? So we're simply going to review. If you think you're having a deja vu, you are not. It's something that we already saw in Chapter 1, in which we're going to go ahead, we purchase raw materials, right? We purchase the raw materials, and then what? As we issue the materials, some of them are direct, so they go straight to work in progress, okay? Our direct materials, as we gather our manufacturing cost, our product cost in our work in progress. Indirect materials first go to the overhead, and then we're going to use the predetermined manufacturing overhead rate to apply that to work in progress, right? Okay? There's the general journal type entry, debiting the raw materials when we purchase them, $45,000, crediting what? Crediting the accounts payable, cash, whatever we paid for those. We go over and we say, okay, 40,000 of that was direct, so it went to work in progress. 3,000 of that was indirect, so we debit the manufacturing overhead for that, right? Okay, and I'm going to go ahead and put up on the board, why don't we go ahead and gather our manufacturing overhead cost. I had a student one time said, we've got to gather our MO. Okay, if that works for you to call that MO, that's okay. Then it begs the question, hey, Larry, right? Okay, never mind. You'd have to. You don't know what that is? Google the Three Stooges, Curly, Moe, and Larry. Okay. My favorite quote from Curly is, I'm trying to think, but nothing happens. Okay, anyway, so you don't want that to happen on your test, so you're going to study all this stuff, right? Okay, so what happens? We sit here, and our manufacturing overhead in this case is going to be the 3,000. So we're gathering the cost in there. Okay, okay, good. Now you come over and take a look, and now we're going to do our labor. And so we'll go ahead and we'll put our labor, direct labor, into work in process, and our indirect labor will go to our manufacturing overhead, right? Okay. And so you come over, there's the journal entry, debit work in progress for the direct, debit manufacturing overhead for the indirect. That's now 12,000, and I'm just teeing up 12,000 here. See, that way, when we record it, they can actually hear the squeak of either that or they'll think we have rats in here. Okay, right? So what happens? We go ahead and we debit the manufacturing overhead for 12,000 for the indirect labor, and the work in progress for the direct 35,000. Of course, we have to pay them, so we set up the payable, right? Okay, good. Now we have other overhead. Remember, other overhead are going to be things like rent on the factory building, the depreciation, the utilities, etc., right? So we go ahead and we do the journal entry for that. We set up our payables for PG&E, accumulated depreciation, property taxes, and unlike we learned in what? In accounting A, business 101A, where we debited depreciation expense, we're trying to gather that depreciation as part of our product cost here, aren't we? Because it's depreciation on the factory building. So we go ahead and we debit the manufacturing overhead for that, $5,600. Okay, and so we've got our indirect labor. I'll call that IL, materials. We've got our indirect labor, 12,000. I'll call that IL. And we've got what? We've got our other. That's lining up in my manufacturing overhead account, isn't it? Okay. Okay, good. So now we're going to have to apply the manufacturing overhead to my work in progress. So notice the actuals do what? The actuals are debits and the credits are to cash or whatever as I incur those, or salaries payable, whatever it is, raw materials. The debits are the actual, right? The credit is going to be the applied. And so I go ahead and I apply using my predetermined manufacturing overhead rate, whatever that was that I had for the year. Okay, so we're going to go ahead and do what? Debit the, oh, here it is. Here is the journal entry. I don't know what I was looking for. So we're going to use what? We're going to use this predetermined manufacturing overhead rate of what? $3.50 times the 5,000 units. We're going to debit our work in progress, 17,500. So it's in work in progress now, isn't it? And we're going to credit our manufacturing overhead. So we credit the manufacturing overhead. 17,000, what is it? 500. And that's what? That 17,500 is going to be debited to what? To the work in progress. So far now in our work in progress, anybody got the other numbers for direct labor, direct material? Nobody wrote that down? Whatever those other numbers were for direct labor, direct material, if nobody remembers, then it doesn't matter. But we would have had direct labor and direct materials there as well, right? Okay, whatever those numbers were. Huh? 43,000 in total? Materials, you say was 43,000? No, it's 40,000 for the materials because 3,000 was indirect. So it was only what? Yeah, so it was only 40,000. And anyone remember the labor? Huh? The labor was what? 35? Okay, the labor is 35. So anyway, the numbers don't really matter that much. But what? We have our what? We have our manufacturing cost here, don't we? We simply had to apply the manufacturing overhead. And that's what we've done now. Okay? Okay, good. Come over and we remind you again that you expense your selling and administrative. You're going to expense those. Okay, and there's the journal entry to expense them. And now we have what? We have, and there's our three items. We have our direct materials, we have our direct labor, we have our overhead applied, and as we finish those, we do what? We take those over to our finished goods by debiting the finished goods, crediting the what? Crediting the work in progress. What do we call that? The amount of finished goods, the amount of items that are finished that are transferred out of work in progress and into finished goods. What do we call that? No. Cost of goods sold is when we sell them. What do we call this number? Oh, hello, it's right there. Cost of goods manufactured. I didn't realize that they called it that. That's the cost of goods manufactured, right? So that's a key definition, guys. That's a key definition because in some problems, I'm simply going to ask you, what is the, I'll show you a bunch of T accounts and I'll say to you, what is the cost of goods manufactured? And you're going to be sitting there losing your mind trying to figure out what the cost of goods manufactured is from these T accounts. Meanwhile, it's going to be the credit to what? The credit to work in progress and the debit to finished goods for the period, right? Okay, so we've got two key terms that are going to be important for you to know. Manufacturing cost, my manufacturing cost for the period, and maybe that's what I should write here. My manufacturing cost, I'm just going to call them man cost. Okay, my manufacturing costs for the period are what? My direct materials, my direct labor, and my manufacturing overhead applied, right? The cost of goods manufactured are for the items that I finish for the period that I go ahead and transfer out of my work in progress into finished goods, right? And what do I call the amount that I transfer out of finished goods and into cost of goods sold? What do I call that? Cost of goods sold, right? Okay, once I sell them, they become the cost of goods sold. Sorry, guys, a little bit of a set you up for a trick question there, but we call it what? Cost of goods sold, right? Okay, okay, good. So we come over, we take a look. There's the what? There's the cost of goods manufactured. How do I know? How do I know that 27,000 is the cost of goods manufactured? How do I know that 27,000 is the cost of goods manufactured? Go ahead. By definition, right? I know that 27,000 is my cost of goods manufactured. Very good. I know because what? By definition, it's the amount that gets transferred out of work in progress, gets credited out of work in progress, and gets debited to what? Finished goods, right? Okay, so we're reviewing this again. We really talked about this in chapter 1, but again, these definitions can start to swim around in your head a little bit on your exam. So make sure you've tied that part down. We have to have what? We have to know that our cost of goods manufactured is the amount that gets transferred out of work in progress into finished goods. Our manufacturing costs are the amounts that get put in to work in progress, right? Right? Okay. Okay. All right. And so there they go as they transfer the items out of our finished goods and into cost of goods sold. We call that cost of goods sold. So actually, if I write in here manufacturing costs, I'm going to write it again. If I write in here again manufacturing costs, this is a perfect flashcard, isn't it? And doesn't this tell you the whole thing? The amounts that get added to work in progress are called manufacturing costs. The amount that gets transferred out of work in progress and into finished goods is called cost of goods manufactured. And then just like it is in 101A, the cost of the items I sell is called cost of goods sold, right? As they come out of finished goods and into cost of goods sold. Okay, good. So that's a good slide. Okay, and there you see the journal entry, just like 101A now. As we sell those items, we set up this receivable, the sale, and we go ahead and debit our cost of goods sold, credit the finished goods. Okay, now we looked at this last time, guys. Okay, and after we look at this, we're going to go ahead and take the break, but let's just sort of fresh in our mind. Maybe we'll look at one more question, and then we'll take a break. Okay, but what happens? We are going to gather our manufacturing cost in our work in progress, aren't we? Okay, and that includes what? Our direct material, our direct labor, and our manufacturing overhead. Those are our manufacturing costs, right? How do we get the manufacturing overhead over there? We apply it, don't we? We apply it by debiting work in progress, crediting the manufacturing overhead account. Meanwhile, we're gathering our actuals as debits in there, aren't we? In the manufacturing overhead account? Right? As we actually issue indirect materials, incur indirect labor, have our utility bills and our depreciation stuff, we what? Debit over here for the actual. So we would have debited manufacturing overhead, credited accumulated depreciation, right? And then we apply it to work in progress to gather our manufacturing costs, right? And so we've got our manufacturing overhead applied, our direct labor, our direct materials. Those are all considered my manufacturing. I take those and I add them to work in progress, don't I? So I have my beginning work in progress plus my manufacturing cost for the period. That gives my total work in progress for the period. And then when I am done with what? I go ahead and take my cost of goods manufactured and I transfer it out. So if you were trying to calculate it in a problem, you'd have your beginning, your total manufacturing cost, that's the total work in progress. Whatever's still left in work in progress, you subtract that off. That must be the amount I transferred out, right? That must be the amount I transferred out. And the way I set it up is BASE, so that I do these problems the same way every single time. My beginning, my adds for the period is going to be my manufacturing cost. My subtracts are going to be my cost of goods manufactured. And then that's going to leave me my ending balance in work in progress, right? Do you want me to put that up again? Remember how we did that? The way I like to do this. See if I can write it here without the screen flipping on me. Okay, so what am I going to have? I like to do this BASE, and I'd be analyzing my work in progress. And so this is going to be my beginning, isn't it? The adds we call what? What are my adds to work in progress? Those are my man costs. Those are my what? My direct materials, my direct labor, that says cost. Those are my manufacturing costs. Those are my direct materials, my direct labor, my manufacturing overhead. Everybody? Applied. Right? Everybody. What are my manufacturing costs? Okay, but what are my manufacturing costs? Direct materials, direct labor, good. Manufacturing overhead, applied. I add that to work in progress, don't I? Okay. Then what? Then I have my subtracts for the period. My subtracts for the period are my cost of goods manufactured, aren't they? That's my cost of goods manufactured, and then my ending balance is whatever my ending balance is, right? Okay, and you can then analyze any question using that BASE approach, so that sometimes they'll say, well, what's the ending balance in work in progress? Well, that's easy. You could use it this way, but sometimes the question will say, what was the manufacturing cost for the period? Well, you're going to have to go back up and figure out the add. If they say, what was the cost of goods manufactured, you're going to have to do what? You're going to have to figure out the subtract in that equation, aren't you? Okay, this is the way I work these every single time when I work them, so that I don't get myself confused halfway through with T accounts or something, or just haphazardly trying to throw the numbers up there. I've been doing this for 30 years, guys. I get in the middle of one of those questions and I'm like, where am I now? If I set them up like this, I don't have that problem. And if I don't get one of the choices on the answer, I said I've been doing this 30 years. I've probably been doing it now. Yeah, 30 years is fair. If you start from the time I was a student, it's over 30 years, right? And if I don't get the answer, I quickly go back up and see where I made my mistake, right? In this thing. So it's a very efficient way of working these. So we have our total manufacturing costs. Our total manufacturing costs get transferred out of what? Out of our work in progress and into where? In finished goods, and that's what you see happening right there. And then, of course, the amounts that come out of my finished goods is my cost of goods sold, right? And I could sit there and do a BASE for my finished goods. And remember, I said that's how you do these. You decide which of the accounts you're analyzing, and then you use the BASE approach for all of them. So I sit there, and for my finished goods, I'd have the beginning balance. My add is what? Cost of goods manufactured. Cost of goods manned Sorry that the writing is so horrible, but the pen will flip the screen if I'm not careful. Beginning, I have my add, which is what? My cost of goods manufactured. My subtract is what? Subtract is my cost of goods sold. The subtract is my cost of goods sold, right? If I'm taking them out of finished goods, they're done. I sold them, right? So the S there, the subtract is what? My subtract is what? Cost of goods sold. I subtract out my cost of goods sold, and then I have the ending balance, don't I? In my ending inventory, in my finished goods inventory. That's the same thing as ending inventory. So it's just like calculating your ending inventory, isn't it? Okay, and if you use that approach, whatever, because the problem will typically tell you the beginning. The two things, they'll tell you the ending. The two things that they're going to make you figure out, that we're going to make you, they say they, like some aliens are going to come in and give you the test. The things that I'm going to make you figure out are going to be what? Are going to be probably the cost of goods sold, which is the subtract from this, or the what? Cost of goods manufactured, which is the add to this thing, isn't it? Okay. We talked about this last time, but let's just take a look at this problem. And this didn't quite turn out, I don't think, the way I wanted it to. But let's look at this problem. And on this panel on the right is what the question wants. And so they tell us, here we go, what is the cost of goods manufactured? That's what that question is asking, and then they give us the choices here. Is this the hardest problem you've ever seen, or the easiest problem you've ever seen? How many want this to say this is the easiest problem you've ever seen? Okay. How many want to say this is the hardest problem you've ever seen? Okay. So most of you don't think it's, well, what's the point here of not answering my question? Just to make me suffer and struggle up here? Let's try it again, okay? How many think this is the easy question? Let me put it that way. How many think it's a hard question? Okay, one person thinks it's hard. You're going to learn something about me, guys. I am stubborn. One time my sister told me, John, you're very stubborn. I said, no, I'm not, and I don't want to talk about it anymore. Okay? All right. So I am very stubborn, and if I ask a question, you don't answer it, I will sit here for the next hour and keep asking the same question. So, how many think this question is easy? Okay, good. There we go. That's just about everybody. How many think it's hard? A couple people think it's hard. If it's the cost of goods manufactured, guys, and thank you for participating in our little poll. Cost of goods manufactured does what? It's going to be the amount that comes out of work in progress and goes what? Into finished goods. You see that? You see that? So we gave you all this rope to mess yourself up. Meanwhile, what? The answer was sitting right there in front of you, right? So this is an easy question, right? It's a definitional. It's really another definitional question. Okay? Okay, good. Let's go ahead and try this one. And this one is saying, what is the cost of goods manufactured? And they start giving me information about what? Work in progress. So can I analyze work in progress to come up with the cost of goods manufactured? It is the what? Subtract from my work in progress, isn't it? Okay, so if I go ahead and I analyze this using BASE, and this is exactly how you'll do it. When you're taking your midterm, you're going to say, okay, BASE, and I'm just going to fill in the blanks here. So, do they tell me the beginning? Beginning is what, 20,000? Okay, good. Remember, we use the ninja approach. We don't fight the problem for anything. We take the energy from the problem to destroy it, don't we? Okay, and so what happens? Then what? Then they tell us at the beginning of the month, so what's the 20,000? Oh, 10,000, thank you. And 10,000 at the end of the month. Good. Thank you, Steve. Beginning was 20. The end was 10. See how I don't fight the problem? Although I got tricked by the problem, but there's the end, is 10,000, right? So I'm just taking the information the problem gives me. Then what? Then they tell me during the month the corporation incurred direct materials of 50, direct labor of what? 22, and the actual manufacturing overhead was 58,000, but the applied was what? 56. Which one do I pick up? The actual, I pick up the applied, okay? The what? It's up here again, right here. The actual is going to be the debit to the manufacturing overhead account. The applied is the applied that goes to what? Goes to the work in progress, isn't it? I don't pick up the actual. I pick up everybody? Applied. I pick up the applied, so I'm going to pick up that, what is it, 56? Okay, so I'm just going to go ahead and write these off to the side real quick. So I have what? I have my direct materials of 50. I have my direct labor of what? 22. And I have my manufacturing overhead. Which one do I pick up? The applied of 56, right? Anybody got a total for me on those? 128,000? Is that what you said? 128,000? Okay. Were you guys bitten by a calculator when you were little? Is that what happened? A calculator bit you, and now ever since then you're afraid of them? Put the numbers in there, guys. That's why God made the calculators. So what is it, 128,000? That's my total manufacturing cost, isn't it? Isn't that my total manufacturing cost? The direct what? Direct materials, direct labor, the manufacturing overhead applied. That's the total add to this, isn't it? 128,000? Okay, good. Now remember, we said that we have to get used to using subtotals here, don't we? So I have a subtotal, my beginning, plus my adds. What do you get for that? I guess I should be able to do that one in my head. That's 148,000. Okay, so if you had 148,000, your beginning inventory plus your manufacturing costs for the period, how on earth did you get to 10,000? Well, you must have subtracted what? 138,000, and the subtract from work in progress we know is our cost of goods manufactured, which is what the problem wanted, isn't it? Okay. I like to set these problems up the same way every time, guys, with that BASE, because then I know I got a system. And I know that I can what? Just plug the numbers into that system. If you're always struggling, let's see, what are they asking me for? I'm going to do this one that way, that one this way. You're like the tennis player that is running back and forth across the court while your opponent is hitting the ball high, hitting the ball low, hitting it to your left, hitting it to your right. If you sit there and you got a systematic approach to these and how you're going to approach each one of these, then you can handle any one of these problems, right? The challenge in these is not so much or not only just knowing the material, but it's also being able to do it in the time constraint that we're going to place on you during your midterm, right? Okay. Okay, good. Any other questions on this one? Okay, guys, let's go ahead and get started back as we now start to wrap up our discussion for Chapter 3. I mean 2. Okay, so let's go ahead and wrap up Chapter 2 here. And we have on this slide this notion of over versus under applied overhead. Okay, when we left, we were making the point that what? We had actual overhead here of 20,600. Meanwhile, our applied was 17,500. So what do you think? Did we over apply or under apply the overhead here? In this example, we had what? Good. We had under applied it. And we want our manufacturing overhead account to be 0 at the end of the year because we want those costs to have been included in, hey, work in progress first, and then as those costs go out of work in progress, they go to finished goods, and then as they go from finished goods, they go to cost of goods sold, don't we? So we want all of our manufacturing overhead costs to have been put in one of those inventory accounts. Work in progress inventory, finished goods inventory, or I guess cost of goods sold is not inventory, or our cost of goods sold, right? One of those 3 accounts. So if we have an under applied here, we have more debits than credits, don't we? What's the difference here? We have a $3,100 difference between these two, don't we? Okay, so since, my debits are more than my credits, if I credit my manufacturing overhead, $3,100, I have to debit something, don't I? Okay, now, if this amount is not considered material, it is okay for me to go ahead and debit my cost of goods sold for that extra $3,100. Now, this is balanced out, isn't it? I've credited this is 0, and my cost of goods sold now has $3,100 extra in it, which it really should have more in it because I under-applied the overhead, right? And they tell us that if it's not material, I can just go ahead and put the entire amount into cost of goods sold. If this amount is a lot, it's considered material. What makes something material? What makes a fact material or number material? Huh? No, I don't mean raw material, sorry. Material meaning that it can, and I'm just going to give you the definition because you're right, we have raw materials. What makes something material? Is it raw materials? No. Indirect materials? No. Direct materials? No. What something makes something material, meaning is it material to the decision making of users? Okay, would it? Forget about cost accounting. From a standpoint of financial accounting, okay, forget a managerial for a second. From a standpoint of financial accounting, a fact is material if it will change the decision process of a user of our financial statements. So it's not material. So it's saying what? If I had known that the financial statements were misstated by $10,000, I wouldn't have bought the stock. So in this case, the $3,100 wouldn't be material to that decision making. If someone would say, I wouldn't have bought the stock if I knew the financial statements were misstated by $2,000, now this $3,100 is material, and we would have to take an approach where we would allocate this under applied overhead between the 3 accounts where it could possibly have to have resided, which is what? The work in progress, the finished goods, the cost of goods sold, right? So if it's not material, you stick it all in the cost of goods sold. If that amount is material, right, has a materiality level that we've reached, then what? Then we have to go ahead and allocate it between our work in progress, our finished goods, and our cost of goods sold. Okay, so 2 approaches. You can dump it all in cost of goods sold or allocate it between those 3. Okay, now that's where we're going. So let's just go ahead and take a look. Before we go through the rest of the slides here on this, what would happen if I had actual overhead that was more than the applied? So just humor me for a second. Let's say instead of this number being 20,600, let's say this number was 16,000. Lord got fired. Why? Because he wrote on the board without a dry erase pen. Okay, so what happens? 16,000, okay? Let's say we had actual of 16,000. Have we under or over applied now? Now we have over applied. Okay, that says over applied. Now we have over applied, and if we over applied, do we need a debit or a credit to close this thing out? Just forget this number. Let's just say it was over applied. It was 16,000. It was over applied. Do we need a debit or a credit to close this thing out now? We need a debit of what? 1,500? This would be zeroed out now, wouldn't it? This would be zeroed out now? right? Forget these numbers up here. I'm just saying if it was 16,000, we have more what? We have more credits than debits, don't we? So we want to what? We want to put a debit in here to close this out. This is 0 now, isn't it? We have to credit something, and in that circumstance, we would do what? If it wasn't material, we would credit cost of goods sold. If that amount is material, we'll have to allocate that credit between what? Work in progress, finished goods, and my cost of goods sold. Okay? So it could be over-applied, could be under-applied. Okay, so let's just go ahead and let's take a look at this now and see what we have. And they tell us that in this example that we had actual overhead of 650 and we had a total of 170,000. You know what I'm going to do? I'm going to erase the numbers that we've been messing around with up here, and I'm going to go ahead and use these numbers, and we'll just write that. I guess I'll write it on the screen. What the heck? So now I'm sorry I erased it off the board. Let's go ahead and let's just write it over here. And so they're telling me if I have my manufacturing overhead, and they tell me that the actual was what? 650? Okay, so that's the debit for the actuals, right? Okay, and the credits would have been to what? My utilities payable, my accumulated depreciation, my credit to wages payable for indirect labor, my credit to raw materials for indirect materials, right? Okay, and now I have the debit, 650,000 here, and then they tell me that I did what? I had 170,000 direct labor hours for the period. My predetermined manufacturing overhead rate, thanks guys, now they're back to the $4. Can you make up your mind? Can you use the $350 or the $4? Now they're back to what? Using the $4 here, I multiply my predetermined manufacturing overhead rate, which I would have come up with by using the high-low method, right, like we practice with, or maybe I'm using regression analysis, whatever. But I come up with that predetermined manufacturing overhead rate. I multiply that times 170,000 direct labor hours. That means that I applied what? 680? $680. So the actual is the debit. That says actual. And the credit is the applied, isn't it? So do I have an under or over applied here? I have an over applied, so I need a debit over here of 30,000, don't I? So that's now zeroed out, isn't it? And the question becomes, where's my credit going to go? And if it is not material, that credit will all go to what? My cost of goods sold, right? In other words, I'm saying, hey, my cost wasn't, for my overhead that for the items I sold wasn't 680, it was actually 650, and I adjust that at the end of the year by going ahead and closing out my manufacturing overhead. If it was what? Over applied, I'm going to debit it to close that and reduce my cost of goods sold by crediting it. If it was under applied, I'm going to have to do what? I'm going to have to credit my manufacturing overhead and debit my cost of goods sold, right? Right? Okay, good. So let's just go ahead and let's take a look. And, ooh, cool. It's what? Over applied 30,000. Okay, I liked our little scribbling better than that cool graphic, but okay. That's the 30,000 that's over applied. So what are we going to do? We're either going to take it all to cost of goods sold, or we're going to do what? Allocate that between our work in progress, our finished goods, and our cost of goods sold. Those are our two options. Okay. Obviously, if we take it all to cost of goods sold, the way I just sort of scribbled up on that last slide, we go ahead and, because we have over-applied, we debit the actual to close it out to zero. We credit the cost of goods sold, right? Right? Okay. If, which is what we showed on that other slide, if we decide to allocate it, we allocate it to the 3 based on the portion that each one of these has to the total of the 3. So you add up the amount that's in your ending balance in your work in progress, the amount that's in your ending balance in finished goods, the amount of your cost of goods sold for the period. You add those 3 up. That gives me 480, right? 680, excuse me. That gives me 680, right? And what happens? If work in progress had 68,000, it constitutes 10% of that total, doesn't it? So we take the what? We take 10% of that. That means that 3,000 of the total 30,000 would be allocated to my work in progress. 30% would go to finished goods, and 60% would be going to cost of goods sold. So it's just allocating that 30,000 between the 3 accounts, right? And each one of them would receive a what? Would receive a, were we under or over applied here? Now I forgot. Since we were over applied, each one of those would receive a credit for that amount, right? For the respective amounts up here. Okay. Question? So, material fact means that it will change somebody's decision. Okay? Do you want to buy a stock if you know that the financial statements are misstated by $1? Okay, then you need to kind of shift your perspective a little bit, because $1 is not material enough to change your decision. Okay, I thought you were going to say no. If financial statements are misstated by $1, you're not going to want to buy that stock?
Doesn't matter.
It absolutely matters, because this is answering your question. If you want to, if you're telling me that I'm asking you if you want to buy the stock in this company, and this company showed a net income of $19 trillion. So the company showed a net income last year of $19 trillion. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. That's $19 trillion was their net income. The beginning balance in their retained earnings was $100 trillion. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So the ending balance in their retained earnings now is 100, now I've done it to myself, 100 and what? $19 trillion. I don't know if I'm writing this number correctly. 1, 2, 3, 4, 5, 6, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. $119 trillion is the, 119 trillion is the balance in their retained earnings account, right? With me so far? And I'm telling you that this number is misstated by $1, meaning it's not 119 trillion, it's 118 trillion 999 billion. Do you want to buy the stock of this company? I'll sell it to you for $2. I'll sell you the stock of this company for $2. Okay, you want to still buy the stock because you're like, I don't care, because they've got this $119 trillion sitting in retained earnings, man. There's a payday coming to somebody someday, and I'm going to want to be one of the stockholders that get that dividend, right? So that $1 was not material to your decision to buy the stock. You said, I don't care about that. Get that out of my face, right? Right? Okay. And so a fact that would change your decision is material. The fact that would change your decision is material. Now, if I told you that the financial statements were misstated by $119 trillion, you'd say, okay, well, I'm not interested in that stock because this number could be zero, couldn't it? And I'm not ever going to get a dividend out of that. I'm not going to give up any of my money to buy this stupid stock because who knows what the right number is, right? Okay. Auditors use this idea of materiality. If I'm auditing the financial statements of a company, I can't look at every single transaction. I'll be there the rest of my life. So what do? I set a materiality level that's going to guide what I look at, and it helps me to look at the big stuff, doesn't it? And it helps me to direct my attention towards items that have the potential of harming my investors, right, if they had known those material facts, okay? And so all we're saying here with this example is if the amount's not material, it's not going to hurt anybody if you take the path of least resistance, just slap it in all the cost of goods sold, right? But if that under or over applied is a big amount, it's material, we need to be a little more careful about how we do. We just don't slap it all in the cost of goods sold, because remember, when we put the amounts in our manufacturing costs, first they went to work in progress, then they went over and they went where? Then they went over and they went to the finished goods, and then they ended up in the cost of goods sold, right? Okay, is that business 101B?
Yes.
Okay, good. And so what happens? We sit here, and if it's material, we allocate it between those three places where that manufacturing overhead could still be residing in one of those three accounts, right? As our manufacturing costs move through those three accounts.
But basically, isn't it, that's what it would end up anyway?
Yes, but in what period? Okay.
Okay.
In what period, right? So, I mean, let's say it's...
First period, fourth period, the following year period.
Yeah, or what if we're building, a building that takes us a couple of 3 years? The average life of our product is 3 or 4 years. Well, now we've put that amount in there 3 or 4 years in advance, haven't we? And if that amount is material, we put it in cost of goods sold in advance of the period that it should be there, right? And if that's a material amount, what's going to happen? In year one, we're going to understate our net income. And some people would say, okay, so you understate your net income so the investors aren't harmed because they'll just sit there and they won't decide to buy that stock. The problem is the later years, my net income will be overstated. And this could be, if this is done intentionally with the company where they're misstating it and this is now fraud. And this is the type of schemes that companies like to, they figure all this out, don't they? And they say, I know, just put everything in cost of goods sold this year because we had a nice year and we had a lot of revenue. But I think the later years 4, 5, 6, 7, 8, 9 ain't going to go so good. So let's do the over-applied. In fact, let's over-apply it on purpose. Let's over-apply it on purpose this year, and then later years will be more realistic, etc. They get into all kinds of funky schemes at that point, right? Okay, so we got to stay ahead of these guys, and we've got to understand that if it's material, we would be looking for this sort of an approach, right? Okay. If it's material, no, you have to do it this way. If it's immaterial, you could do it either way you want. If you still want to go through this trouble, that's fine. No one's going to stop you from doing this, but they're allowing that if it's immaterial to just dump it into cost of goods sold. Dumping it straight into cost of goods sold is a little bit of a misstatement, isn't it? But if it's not material, it's okay to do that. Okay? Okay, good. So let's go ahead and just see what the journal entry would look like if they, allocated it between the three, which is the debit to the manufacturing overhead, because we had what? I guess we had under-applied it. Get it right, John. We had done what? We had over-applied it here, so there was too much in the credit side. We debited the manufacturing overhead to bring it to zero, and then they decided to allocate it between these three to credit it. Okay? If it's what? If it is over-applied, we're going to have too much of a, I erased it now. Okay, let's just write it up here. again, just to make sure, because I think I may have confused you a little bit there. If it is what? If it is manufacturing overhead, what goes on the debit side? Actual or applied? Actual is on the debit side. I'll even write it here. Actual is on the debit side. Applied is on the credit side, right? If it's over applied, that means we did what? We over applied. We have too many credits, don't we? We have too many credits. So to close this out, we will do what? We will debit manufacturing overhead. We have to credit something. If it's not material, we will do what? Put it all in cost of goods sold. If it is material, we'll do like we're doing here, allocating it by crediting cost of goods sold, work in progress, and finished goods inventory, right? Right? Okay, so that's if it's over applied. If it's under applied, what happens? That means that my actual was more than my applied, wasn't it? Okay, so to close this out, I'm going to do what? I'm going to go ahead and now credit my manufacturing overhead account. I have to debit something. I'm going to debit what? Cost of goods sold if it's not material. Work in progress, finished goods, cost of goods sold if it is material, right? Based on the relative percentage it each has. Okay. Okay, good. So with that, let's go ahead and let's take a look at a couple of quiz questions for that. And so we're sitting here, and we have this Sawyer's manufacturer uses a predetermined manufacturing overhead rate based on direct labor hours to apply manufacturing overhead to jobs. Last year, the corporation worked actual hours of 57,000 hours, direct labor hours, incurred 345,000 of actual manufacturing overhead, and the corporation had estimated that it would work 55,000 hours and incur 330,000 of my manufacturing overhead. So this is sort of a two-part problem. First, you have to get the predetermined manufacturing overhead rate. Then you have to do what? Figure out what should have been applied for the period, and then the difference between the actual and the applied is going to be the under-over applied overhead. So this is actually what? 3 steps, isn't it? Okay, so let's first go ahead and do that first part, and notice that they get the predetermined manufacturing overhead rate, and they say that that is what? $6. How did they get that? They're going to take what they estimated the total amount of overhead would be, and so they did what? They estimated it would be 330,000. Is that what they estimated here? Okay. And they're going to go ahead and they're going to divide that by how many direct labor hours? They're estimated 55,000. Does that give me the $6? Do I have a second on that calculation? That gives me the $6? Okay. Okay, good. I've got this $6 now, and so what do? I take that $6 right here and I multiply it times the actual hours that they worked for the period, didn't I? That's the actual hours that they work because I apply it based on the actual hours. So if I'm sitting here and I'm just looking at my manufacturing overhead account, I sit there and I'm going to credit it for this 342,000 for the applied. Applied goes on this side, doesn't it? That's going to be what, 342,000? Okay. Meanwhile, they tell me, they just gave me the actual. Actual is what? 345,000, isn't it? Okay. So I have more debits than credits, don't I? I have more debits than credits. So since I want to go ahead, I have a what? I have an under applied, and since I want to go ahead and zero this out, I'm going to do what? I'm going to credit this 3,000, that will zero that out. And again, if it's not material, it can just go straight to cost of goods sold. The whole 3,000. Okay. But I had what? I had a under applied of $3,000 was the answer to this question. They didn't ask me where to close it out to. But the answer to this question was I had an under applied of 3,000, wasn't it? So this is a nice little comprehensive question, isn't it? It didn't make us calculate the overhead equation. They just gave me the numbers, which is where we'll start. We're not going to have to use high-low method in that, but we are going to have to know that once we're given the estimated amount of overhead for the period, the estimated number of units, we're going to have to know how to calculate the predetermined manufacturing overhead rate. We apply it based on what? Based on the actual hours that were worked for the period, and then the difference between the actual overhead and the amount that we applied is going to be my under or over applied, right? And in this case, it was under applied. Okay? Okay, good. Let's take a look. I think there's another one that we can mess with. Get a little extra practice with this. That's not the same problem, is it? Oh, okay, good. Looks like it, but not quite. But it's gonna feel like deja vu. I think it's pretty much the same thing. So what happens at the beginning of the year? We had estimated total overhead costs of what? Oh no, this is a little different, and it's a worthwhile difference. 350,000. Okay, and my direct labor costs are 200,000. So now, guys, we go ahead and instead of using the hours, we use the direct labor dollars. And when we do that calculation, it turns out that we have what? We have $1.75 per direct labor dollar that we're going to allocate to our overhead based on our direct labor dollars as the driver. Why would you use direct labor dollars instead of hours? Why dollars instead of hours? Because people get paid different amounts, and we could have different levels of cost coming in, right? The other potential problem there is what? Maybe we have different types of structures if you work this long versus that long, etc., right? And so if there's overtime involved, and so what happens? If you use direct labor dollars, that could be a more accurate driver, couldn't it? Okay, so we go ahead and we sit here and we use this $1.75. We pick up now, and that's really the only difference. We pick up our actual hours for the period, which is what? The 208 is the actual. There it is. We pick that up. We multiply that by the amount per direct labor dollar here is 362. $1.75 per direct labor dollar is 362. And we compare that to what? To the actual overhead cost. They tell me the actual overhead cost was what? 362. That difference is this 2,000, isn't it? And since we did what? Since we applied more than we incurred, we are going to have what? An over-applied amount, right? Okay. Just once again to put that into the T account perspective, manufacturing overhead. The actual was what? 362 was debited. Right? The actual is the debit. The applied was how much? Was 364. Okay. So we were over applied, weren't we? Okay. So when we're over applied, and that's all we had to do for this problem, but again, we would have debited the manufacturing overhead account, and we have to credit something. We would have credited what? Cost of goods sold if this 2,000 is not material. If it's material, allocate it between finished goods, work in progress, cost of goods sold, right? Okay. Questions? I think that's it. Let's see. This may be it, and it'll close itself out. Oh, one more? You want to do it or no? All right. That's the spirit. Okay. So let's take a look. And so what happens? We sit here, and they're asking me what should be recorded on the job cost sheet. Okay, so this is sort of testing our definition of job cost sheet and what goes on in there. But we know it's direct labor, direct materials, and our manufacturing overhead, the applied, isn't it? Okay, and so that's all they do. They pick up what? They pick up the direct labor. Thank you. They pick up the what? Direct, I said direct labor, but I meant direct materials. They pick up the direct labor, which is simply my hours times my direct labor rate. Right there, right? Easy enough. And then I had 175 machine hours, and they tell me that my predetermined overhead rate is $14. This was just a definitional question, wasn't it? When you got right down to it, you had to know a lot of things. You had to know what's a job cost sheet. You had to know what goes on to the job cost sheet, and then you had to know, well, that's pretty much all you needed to know. Okay? So that question's just, that's too easy for you guys. We can't give you that on the midterm, can we? You don't want easy questions like that. You'll walk out ashamed of yourself. Geez, I aced that test. It was just so easy for me. Okay. Okay, that's the end, right? Okay, when you see that, you know we're at the end of the chapter. Okay, all right, guys, so a couple of things for next time, all right? And I'm going to get it up there sooner than the day of this time. I will have Chapter 3's slides and the Chapter 3 quiz, although I will continue. This works pretty good, right, to embed the questions in with the slides so we can kind of see how the quizzes relate to the exam. Okay, so I will do that again. I will have that posted under Chapter 3. This lecture will be posted under Chapter 3. So if there's a particular area that you want to look at again, it'll be in an MP4 format so you can move around forward and backward to look at what you want to. Chapter 2, sorry, Chapter 2. I keep thinking Chapter 3. Chapter 2, this will be under Chapter 2's lecture, and you can watch it as many times as you want, whatever. Chapter 3 slides with the quizzes will be in there, and the quiz will be there in Word format as well. For Chapter 2, there are additional quiz questions that I did not embed in here. Okay, so you may want, you will go back to that Chapter 2 quiz and look at that again, practice with it again. Some of them you'll have deja vu. You'll be like, oh, I remember this question. Other ones you'll go, huh? And you'll have to face some live pitching for those, right? Okay, we'll just continue that process. So next time, Chapter 3 slides with the quiz questions in there, right? And also have the Chapter 3 quiz up in Word form as well, not Word Perfect. You don't have to do anything. As long as you show up to class, I will give you the points for the quiz. Okay, as long as you do that. And I'll I'll light up some questions and connect so you can have extra practice with those too. But again, you don't get credit for those, but you've bought the code, so you want to get in there and look at those. So we'll get that set up for you. Yeah, we'll get it set up. Okay, guys? All right, have a good rest of the week and weekend. We will see you. By the way, usually we have class on Monday, right? So we'll be back on Monday. Okay.
Does the Connect only work if I sign up for your class, or can I use it like anytime?
What do you mean if you sign up for my class?
Like for instance, if I wasn't in this class and I bought the Connect code, would I still be able to use it?
No, you got to be in the class.
In the class, right?
Yeah.